Well, hello there. This is Nick Stern tuning in from Robos and You Financial Services. I'm a certified financial planner here and hope you're doing well. I hope you all had a nice Thanksgiving and you're enjoying a pretty mild fall up here, if you're, or at least in the Northeast, and if you're out west, I think you're enjoying some pretty nice weather. Anyway, I'm going to jump right into it. So I know you're busy and I know you have other things to do besides watch me talk. I want to talk about Robos and You, aka robo advisors. Are they good? Do they make sense? Yes, we know that they're cheaper in some cases, and they tend to at least appear to offer quite a bit of benefits, but they might not be for everybody. So let's just jump right into that right away. What are the advantages? So with a robo-advisor, if you're a person who does not care whatsoever about talking to somebody or talking to the same person all the time, or having any type of, for lack of a better term, personal touch, then maybe a robo-advisor, this means a robo-advisor, I should say, is for your investment dollars, might be right for you. It looks like there's a trend going on, which is, I find, kind of ironic, because they're looking to be as cost efficient as possible, yet they are adding people to talk to, which seems a little counterintuitive to some degree, but I would say the robo advisor piece is really on the investment side, where there's literally no emotion into it and they're just looking for certain quantitative strategies based on factors that they come up with, that they input into these computers, and that's how your money's invested. So anyway, I went off a little bit of a tangent, and I'll be upfront, I'm probably a little biased. We're in-person, full-service advisors. But I think that the big benefits are, one, like I said, if you're a person who doesn't care about personal touch, they really don't care about talking to somebody, and this is something that you're just going to set and forget. Set and forget meaning 10 years, 15 years. Then it's worth exploring. More often than not, between now and then, you might want to talk to somebody, and I'm pretty sure that you can get a hold of somebody at one of these robo-advisors. But just keep in mind that they might be less in tune to who you are and just might be the service person on the other end of the line, which is fine. I'm sure they'll be very nice and helpful. But if you're looking for any type of more of a connection when you're talking to somebody, it's probably not the right place for you. From an investment standpoint, and this is just generally speaking, they're going to go to as low cost investments as possible. So quite a bit of exchange traded funds that they're going to be thinking and using. An exchange traded fund is more or less a very cheap way to buy a specific index or indexes, some of which might have various factors or quantitative strategies that they use that actively manages the portfolio. Overall, they're good in general. Of course, they fluctuate and there's no guarantees or anything like that. I would caution that you should really look into the exchange traded funds that they'd be using, because there are, like anything else, or can be, inherent problems with those types of investments. So again, I'd say the biggest advantages are, one, they're going to be lower cost, and two, it's more of a passive type strategy of investment where they're going to use an index or an index-like investment, and that's how they can keep it low cost. If the indexes do really well, you'll do really well over a long period of time. I would suggest do your own research, but take a look at how indexes perform over a very long period of time, like a 20-year period or a 30-year period, and then you can make your own or draw your own conclusions about how being invested solely in an index, whether or not that makes sense for you based on your own risk tolerance and expected return, etc. So at first sight, I would just say that yes, they sound pretty good, but it's really going to be, like I say all the time, dependent upon what you want and what you're looking for. If you're going to be looking for more of somebody who you can connect with that's going to be able to help you not only on the investment side, but also more on a planning side, or somebody that you want that's going to get to know you and be more of a go-to financial person versus just an investment manager, I'm not sure that would be a robo-advisor would be the right thing for you. As far as the outcome or outlook of them, I mean, I think they're going to be here forever, but overall, if you notice, there's constantly change within the robo-advisors that are basically looking more and more like traditional advice, where they're adding people to talk to and certified financial planners. And I think the biggest differentiator, at least on that side, is just, the low cost piece. They're only going to use a certain type of low cost investment like an exchange traded fund. And there's nothing wrong with that, but there are certainly other ways to achieve a given rate of return based on your risk tolerance. And just solely focusing on low cost might not always be the best option. It might work for a certain period of time, but it doesn't mean that it's going to work forever. So that's another thing to consider when you're looking at least from an investment standpoint, the strategies that they employ where it's solely quantitative. I would say that overall the current market environment that we're in is very emotional. There seems to be a lot of knee-jerk reactions up and down to news here and there that either has to do with the company or industry. So that's something to keep in mind, the psychological aspect of it, and not just focusing on the numbers, but incorporating both types of thinking. So when you're going into a robo-advisor and you're looking at it, you're looking at the benefits, also think about that aspect as well, because that's, at least from my own knowledge standpoint, that's really what they thrive on, is the low cost or very low cost or trying to be low cost structure. So that's really my 2 cents on it. It's just general considerations. My only word of advice to you is make sure that the sole reason why you would go to a robo-advisor isn't cost. We're in an environment where everybody's looking shorter and shorter and shorter and shorter term. Think about one of the most successful investors ever, Warren Buffett. He has such a long-term time horizon, meaning years, not even quarters, years, 10 years. So it's important that, depending on what the money's for, that you think about that too. And that's why I would just say, don't just focus on cost. Yes, cost is really important, but cost isn't the only factor, and it's not the only thing that's going to basically help you be a successful investor or help you have a successful and positive portfolio year after year. There's, of course, always going to be ups and downs. And what I would say, too, is that in periods of down, see how those low-cost portfolios perform. Just have that understanding as well. So, I mean, we've been in such an up period that sometimes we can forget that there might be a down period. And if there is, how does that look in these low-cost types of structures? Again, obviously I'm a little biased because I'm an in-person full-service advisor, but I'm not saying that robos are bad. There's lots of benefits to them. There's also some disadvantages, and I just think it's really important that you're aware of both sides, and you're aware that there's a reason that some of this is really low cost. So with that being said, thanks so much for tuning in. I hope you have a great day, and if I don't talk to you sooner, have a great holiday. And of course, I'm always here for answering any questions. You can take a look at our website, no obligation whatsoever. So thanks, and talk to you.